Carmignac. Y contamos con Axelle Pinon, que es Equity Product Specialist Manager en Carmignac, en la gestora. Axelle, thank you so much for having us a few minutes.
Thank you. Hi, everyone.
Axelle, inflation is still the main worry, or one of the main worries in markets. This week we've known the CPI of the US, Spain, Germany, UK and France today. What are your expectations as central banks try to halt this inflation?
This morning actually we had the French inflation after a very disappointing CPI number from the US on Tuesday, and it came higher than expected, so following the trends, because energy prices in France slowed less than expected, food prices keep accelerating at a sharper pace. But what is important to have in mind is that in France, the intervention from the French government keep the rate much lower than the rest of the eurozone, because we are around 5.9% versus 5.9 in France versus 9.1 in euro area. And the French government says that they will limit going into 2023 the energy price rise by 15% for household. So it's huge. And it's not just France that we are seeing having some initiative of energy cap in order to fight inflation. Brussels also yesterday unveiled some measure in order to limit the impact of soaring prices in Europe. And what the European Commission proposed is to set a mandatory threshold for prices from companies that produce low-cost, non-gas energy, such as nuclear companies, renewable companies. And these companies will have to give the European Union states the excess profit that they have generated beyond this level, and this level being at 180 euro the megawatt hour. And Mrs. von der Leyen mentioned that the EU states should get approximately 140 billion euro from these windfall taxes on energy companies. But what is important is that all these measures will cushion vulnerable households. But it did not address the question of the energy bill of the corporate sector. So what we are having is inflation with a risk on growth, because corporate will suffer from these energy prices. So definitely for the ECB, it makes them in a tough position. We expect a 75 basis point ECB hike in October, followed by a 50 basis point in December as a minimum. And it could be even higher if we don't have a gas price cap at the EU level. But the ECB really think that the policy should be restrictive right now. And the ECB wants to be very hawkish because they really want a material shift downward for inflation or for the activity. And even a mild slowdown, according to them, will not be enough to go back to the target. And indeed, they have done several scenarios, and even in the most adverse scenarios of gas rationing with no substitution, so really going into recession, it will not destroy enough demand to get inflation to 2%, so the ECB target, by 2024. So in any cases, ECB will remain hawkish, and that there is very little change that they will change the course of things in the coming months. Same for the Fed, and I think that it was a good reminder for the market after Tuesday CPI.
Yes, in fact, next week the Fed will announce its monetary policy decision. Do you think 100 basic points rate hike is possible next week?
Yeah, it has been the news after the CPI number, because now the odds of the Federal Reserve could opt for a full percentage point rise in September rose to roughly 30%. At Carmignac, we really don't believe that the Fed will accelerate because they are very close now to what they call the neutral rate, so to restrictive territory. But the issue is that they are struggling to know where exactly is this terminal rate. So closer you are getting to the terminal rate, the more you want to go carefully. And 75 basis point is already an unusual pace of hike. So we really think that the Fed will stick to 75 basis points. But what we have today is very interesting because we had an inversion of the yield curve in the US, with the 2-year treasuries offering yields of 35 basis points over the 30-year rates, sending really the inversion of the curves to levels that we have last seen in 2000. And the reason behind is that the neutral rates keep falling due to the fact that we have in the US still huge amount of debt. The leverage in the US is massive. Therefore, what we do is the short-term neutral rate is much higher today than the long-term neutral rate. And what is happening is that the Fed is increasing its short-term rates sharply because they want to break inflation and wage dynamic, but it's supposed that they might have to cut it in 1 or 2 years in order to return to a more sustainable level, in order to absorb this huge amount of debt that we have in the US.
And Axelle, in Europe, we don't know where the terminal rate is or the neutral rate. How do you think it can evolve this dialogue or this perspective from the ECB?
Yeah, today the market is seeing for the ECB a terminal rate around 2.60, 2.65%. So what we think is that today in Europe, it's quite, there is a lot of things are already priced in the equity market in terms of ECB, what they can do, and also in terms of bad news. Because in Europe, the biggest news that we had over the last week has been the Russia cutting gas for Europe, and it has been quite scary for European market. But since then, what we had is some better news flow from the gas perspective regarding a higher level of storage than expected, regarding the fact that LNG and nuclear supply should be higher than initially expected, and the fact that we have companies that are substituting gas by other energy like oil. Everything. So we have already in the European equity the price of ECB hikes that are fairly priced. We think so. The fact that gas might not be as bad as we initially think, and everything coming on valuations that are already quite low in Europe, because we are already back in terms of valuation at the lowest level of the COVID crisis. So we think that on equity, on European equity at least, the move maybe is already pricing all this bad news, and we can have a support here and not going so much lower. On the rate front, when we look at the 10-year, we are back at the level of June. Back at the level of June, while we have, compared to June, much higher inflation and much more hawkishness from the ECB. So we see that there is really a ceiling on the rates, on the 10-year rates, especially Germany. And we think that it's due to the fact that the markets are anticipating recession in Europe. It will be tough for Europe not to go to recession going into next year, and recession that might be caused not only due to the gas, but also due to the fact that ECB is tightening and that we have strong inflation. So all in all, we think that maybe a lot of news are already priced in the European market today.
Axelle, how do you see from Carmignac equity markets in Europe versus United States?
But like I was saying, in Europe, we think that a lot of bad news are priced. So today we have cut most of our hedges in European equity, but we keep in Europe a very cautious positioning overall, because there is still earnings that could suffer from downward revision, and we still have the impact of a very hawkish ECB. So what we do is in Europe having less hedge on European market, but a very defensive European portfolio. While in the US, the situation is a bit different because on Tuesday we had the biggest sell-off of US equity market since March 2020. Every single stock of the Nasdaq closed in red. And because markets were a bit too optimistic about the fact that we reach inflation peak and that the Fed might pivot in the near term. But on Tuesday, unfortunately, market came back to reality that inflation may not come down before a while. So we remain cautious on US equity because in terms of valuation, we think that the level of the US 10-year is implying much lower valuation than what it is currently. Currently, we are around 17 times forward P. So we think that it could a level of rate at 3.4 like today, it could imply much lower valuation on equity, and the fact that in the US, especially, earning growth remained very high. And when we talk to companies, we are surprised by the fact that they never mention really the potential of inflation on their margin. And as we will enter in a few weeks in the Q3 earnings season, we might see company being more cautious, especially as they will focus more and more into the 2023 outlook. And that could be not very favorable for equity investor. So in the US, we remain cautious until we get lower valuation that will reflect both higher rates, Fed hawkishness, and lower earnings due to the margin pressure. While in Europe, we think that a lot of bad news are already priced in. Valuations are much more attractive. So technically, more overweight Europe versus the US, I will say.
Axelle Pinon, thank you so much for having us a few minutes in Negocios.